Imagine waking up tomorrow and the dollar on your paycheck, the one you use to pay your rent, fill your gas tank, buy your groceries, is suddenly worth a little less. Not because of inflation, not because of a recession, but because the world quietly decided it doesn't need the dollar anymore. That's not a conspiracy theory, that's not a movie. That is the actual scenario that economists, central bankers, and hedge fund managers are stress testing right now in 2026. The Chinese yuan, the renminbi, is making a serious, coordinated, and frankly alarming push to knock the US dollar off its throne as the world's reserve currency. And if that happens, your savings, your retirement, your mortgage, your job, every single financial decision you've ever made gets repriced. So stick around for the next 10 minutes because this might be the most important video about your money that you watch all year. Okay, so let's start with the basics because you cannot understand where we're going without understanding where we've been. Since 1944, and that's not a typo, that's over 80 years, the US dollar has been the reserve currency of the world. What does that mean exactly? It means that when Brazil wants to buy oil from Saudi Arabia, they don't pay in Brazilian reals, they don't pay in Saudi reals, they pay in dollars. When Vietnam buys microchips from South Korea, dollars. When Nigeria settles a trade deal with Indonesia, dollars. The dollar is basically the world's lingua franca of money. And for most of the 20th century and well into the 21st, this made total sense. The United States had the world's largest economy, the most liquid financial markets, the most trusted institutions, and, critically, the most powerful military. The dollar wasn't just a currency, it was backed by the full faith and credit of the most dominant nation on Earth. But here's where things get interesting in 2026. That share, that 73% global reserve dominance the dollar held in 2001, it has quietly, steadily, almost imperceptibly been shrinking. As of early 2026, the dollar share of global foreign exchange reserves has dipped below 54%. That might not sound dramatic, but trust me, for economists, that number is flashing red. That's a near 20 percentage point drop in 2 decades. Now, here's a question you should be asking yourself right now. Where did that share go? Because if the dollar lost it, somebody gained it. And the answer is, it's fragmented. Some went to the euro, some went to gold, some went to the Japanese yen. But the fastest growing piece? That went to the Chinese yuan. And the speed at which the yuan has been gaining ground in 2025 and 2026 is something the mainstream financial press has severely underreported. Think of it this way. The global currency system is like a giant restaurant where, for 80 years, there's only been one chef who decides what's on the menu. And suddenly, a new restaurant opened next door, it's got a line around the block, and the old chef is pretending he doesn't notice. The old chef is the Fed. The new restaurant? That's Beijing. So what exactly is China doing to make this happen? Let's get into it. This is not an accident. China has been running a 15-year chess game, and most Western investors are only now realizing they're 10 moves behind. Let's start with oil. You've probably heard the term petrodollar. Since the 1970s, oil has been priced and traded globally in US dollars. That's been the single biggest driver of dollar demand worldwide. If you want oil, you need dollars. Period. But in March 2023, Saudi Arabia and China completed their first ever yuan-denominated oil transaction, and in 2025, that became a full bilateral framework. Saudi Arabia now accepts yuan for roughly 18% of its Chinese oil exports. That number is projected to hit 30% by 2027, according to the Gulf Cooperation Council's own economic forecasts. Now let's talk about BRICS. In 2023, the BRICS bloc, that's Brazil, Russia, India, China, and South Africa, admitted 6 new members: Egypt, Ethiopia, Iran, UAE, Saudi Arabia, and Argentina. By 2026, this group collectively represents about 37% of global GDP and over 45% of the world's population. And they have been actively, explicitly, publicly discussing the creation of a new reserve currency, or at minimum, a settlement mechanism that bypasses the dollar entirely. Now, I want to be fair here. A single unified BRICS currency hasn't happened yet, and there are massive political and logistical hurdles to making that work. India and China alone have enough bilateral tension to derail any true monetary union. But you know what doesn't need a new currency? Bilateral trade settlements in yuan, and that's exactly what's accelerating.
But here's the play that should make every dollar-holding investor really pay attention: the digital yuan. China's central bank digital currency, called the eCNY, is the most advanced central bank digital currency of any major economy on Earth. Over 260 million digital wallets, over 7 trillion yuan in transactions processed, and in 2025, China piloted cross-border eCNY transactions with 12 countries, including the UAE, Thailand, and Malaysia, through something called Project mBridge. Why does that matter to you? Because the dollar's power partly comes from SWIFT, the international payment messaging system that connects global banks. When the US sanctioned Russia in 2022, it kicked Russia out of SWIFT and froze $300 billion of Russian central bank reserves overnight. That sent a message to every country on Earth. If you hold dollars, the US can freeze them. China's digital yuan is being designed precisely to offer an alternative that bypasses SWIFT entirely. It's financial infrastructure built to make US sanctions less effective. And every country that's ever been threatened with sanctions is paying very close attention. So when people ask, is this really happening? The answer is yes. The scaffolding is already being built, and you can either start understanding it now or be surprised by it later. Now I want to take a step back for a moment, because the best way to understand the future is to look at the past, because this has happened before, not once, multiple times, and the historical pattern is actually incredibly instructive. Before the dollar, the world's reserve currency was the British pound. At the height of the British Empire in the early 1900s, the pound dominated global trade, the same way the dollar does today. Britain was the world's largest creditor nation, the center of global finance, the undisputed economic hegemon. Sound familiar? Then World War I happened, then the Great Depression, then World War II, and by 1944 at Bretton Woods, the pound didn't just decline, it was structurally replaced over the course of roughly 2 decades by the dollar. The transition wasn't one dramatic day. It was slow, gradual, almost undetectable year to year, but then suddenly, obvious in hindsight. And here's the crucial lesson. The countries and investors who repositioned early, they preserved their wealth. The ones who doubled down on British pounds and British gilts well into the 1950s, they took real, lasting hits. This is not about doom and gloom. This is about reading the direction of travel and making intelligent decisions ahead of time. Now, let's bring it to 2026. The United States today is not Britain in 1945. Let me be very clear about that. The dollar still has enormous structural advantages. The US still has the world's deepest capital markets. US Treasury bonds are still the safest and most liquid asset on Earth. The dollar isn't going to zero next Tuesday. But the trajectory, the direction of travel, is something that every serious investor needs to be thinking about. The dollar's share of global reserves fell from 73% to 54% in 20 years. If that trend continues at even half its current pace, we're looking at a profoundly different global financial architecture by 2035. And the decisions you make in 2026 will either put you ahead of that shift or behind it. Here's another historical parallel that should make you uncomfortable. When Rome debased its currency in the 3rd century, individual Roman citizens didn't see it coming. They kept using coins that looked the same but bought less and less. The pattern repeats. The mechanism changes. The consequence doesn't. So what does all of this mean for your actual money? Let's get specific. This is the part where I want you to pause scrolling whatever else you're doing, because what I'm about to tell you is directly relevant to your financial life, not some abstract geopolitical theory. If the yuan incrementally displaces the dollar as the world's preferred reserve and trade settlement currency, here is what happens to you specifically. First, US borrowing costs go up. Right now, the United States borrows money at relatively low interest rates because there is essentially unlimited global demand for US Treasury bonds. Every country that holds dollars needs somewhere to park them, and they park them in treasuries. If that demand shrinks, if countries start holding yuan instead of dollars, the US government has to offer higher interest rates to attract buyers. Higher government borrowing costs translate directly into higher mortgage rates, higher car loan rates, higher credit card rates. Your debt gets more expensive. Your government's debt gets more expensive. And with US national debt now exceeding $36 trillion, the compounding math on that is brutal.
Second, import prices go up. One of the hidden subsidies Americans have benefited from for decades is what economists call the exorbitant privilege. Because the world needs dollars, the US can essentially print money to pay for imports without suffering the same inflation penalty other countries face. If that privilege erodes, the things you buy, electronics, clothing, raw materials, get more expensive. Not a little more expensive, potentially a lot more expensive. Third, the purchasing power of dollar-denominated savings takes a hit. If you have a retirement account, a savings account, a pension, all denominated in dollars, and the dollar loses 10%, 15%, 20% of its global purchasing power over the next decade, that's a real reduction in your standard of living that doesn't show up as a line item, but absolutely shows up at the checkout counter. Now, and this is important, this is not a certainty. The yuan has real limitations. China's capital account is still largely closed, meaning you can't freely move money in and out of China the way you can with dollars. The yuan's internationalization requires a level of financial openness that Beijing is reluctant to embrace because it means giving up control. And trust, the kind of deep institutional trust that took the dollar decades to build, cannot be manufactured overnight, no matter how many petrodollar displacing deals China signs. But here's the thing about risk. You don't wait for certainty before buying insurance. You buy insurance when the risk is real enough that the cost of being wrong is too high. And in 2026, that risk is real enough. All right, this is the practical section, and I want to be crystal clear. I am not a licensed financial advisor, and nothing I say is personalized financial advice. Talk to a professional before making any investment decisions. What I am going to do is tell you what serious money managers and institutional investors are doing right now in response to this exact scenario, and you can take that information and do your own research. Number 1, diversify your currency exposure. If 100% of your savings, your emergency fund, and your investments are in dollar-denominated assets, you are making a concentrated bet that the dollar maintains its current global standing. A growing number of financial planners in 2026 are recommending that investors hold a portion of their portfolio, even just 10 to 20%, in non-dollar-denominated assets. That could mean ETFs that hold international equities priced in other currencies. It could mean gold, which has historically been a hedge against currency debasement and hit record highs above $3,100 per ounce in early 2026. Number 2, look at commodity-linked assets. If the yuan rises in prominence, commodity-producing countries benefit enormously. Countries like Australia, Brazil, Chile, and Saudi Arabia that export the raw materials China needs become more important in a yuan-centric world. Commodity-focused ETFs and resource company stocks could be meaningful inflation and dollar depreciation hedges in your portfolio. Number 3, consider your real estate positioning. Real estate in dollars has always been a good inflation hedge, and that remains true. But if you are heavily leveraged in dollar-denominated debt, meaning you have a lot of variable rate loans, rising U.S. interest rates triggered by reduced treasury demand could squeeze you hard. If you haven't locked in fixed rates, the window to do that intelligently is now. Number 4, educate yourself on the 𝐸CNY and digital assets more broadly. I'm not telling you to speculate on digital yuan. You can't even easily access it as a foreign investor. But understanding how central bank digital currencies work and how they might reshape cross-border payment systems is genuinely important context for any investor over the next decade. The financial infrastructure of the world is changing, and the people who understand that infrastructure will be better positioned than those who don't. Number 5, and this is the simplest one, stop sleeping on this story. Most people are not paying attention to de-dollarization. They're focused on the next earnings season, the next Fed meeting, the next quarterly number. The big structural shifts in global finance take years to unfold, which means you actually have time to position for them intelligently, but only if you start now. Look, here's what I want you to walk away with today. The Chinese yuan is not going to rule the world by next Monday, but it is gaining ground, systematically, strategically, and backed by the economic weight of a country that represents 18% of global GDP. The dollar's dominance is real, but it is no longer unchallenged. And in a world where currency dynamics are shifting, the investors who thrive are the ones who saw the shift coming and prepared for it, not the ones who called it impossible until it was obvious. History is full of people who said the pound would always dominate, that Japan's economy would always be the world's second largest, that the American housing market could never crash. Don't be those people. Be the person who looked at the data, understood the trajectory, and made informed, calm, intelligent decisions. If this video made you think differently about your money, if it gave you something you didn't have before, then do me one favor. Hit that subscribe button, because this is the kind of analysis I put out every single week. Not hype, not noise, just the signals that actually matter for your financial life. Drop a comment below telling me, are you worried about de-dollarization? Or do you think the dollar is bulletproof? I read every single comment and I genuinely want to know where you stand. See you in the next one.
Subscribe to Investify. More financial videos, real insights, zero fluff. Let's build wealth together.